Happy birthday to Brenda Stewart. She turned 95 yesterday, and she's a long 95 years young. She's a longtime realtor in Albuquerque, so happy birthday. Thank you for coming today. Before we start again, I want everyone in the ABCD committee, not just the one who put on this presentation, to stand up so you can see who we are. All right. We're a great group of realtors and affiliates who are involved in the community. And if you have any interest in being part of our committee, feel free to reach out to Carmen Kavnar or to visit our website on the GAR website. So right now, we're in an exciting time for real estate, right? Lots of changes, and I feel like today's the first day of spring, even though we have a little while. But I think this spring is going to be a great springboard for 2026. Today, we have speakers who are going to talk about how to make our borrowers powerful in today's market. We have Debbie Norman and Kimberly Castillo from United South Broadway, Sandy Hernandez from Homewise, and we have three mortgage loan officers, myself, Allyson Mendoza from First National 1870, and James from PRMI. We're going to start the first slide here. You have it on your printout. Sorry, it's not sliding. It's not going to the next slide. So the information on the slide and what's on your printout are statistics from NAR. So NAR's website is available to all realtors, and also if there are affiliates in this group, these statistics are also available to you, and it's great information that you can share with your clients. You can post on social media, but it keeps people aware of what's happening in the real estate community. Oh, bad. Oh. Okay. So I'm not going to go through all the statistics, but you'll see there's great information about the impact of lower rates, housing affordability. Let me see what else is on the far end. Sorry, okay, that's too small. On who's buying houses, the age, and all sorts of different demographics. So take a look at that. Once again, it's on the NAR website, available to realtors and affiliates alike. So before we start, I want to give a special thank you to Sarah Burnson. She's our GAR liaison, and she takes care of everything. We fondly refer to her as Coach because she guides us the whole way, and she helps make this possible and helps make our committee a success. And we're going to start today with United South Broadway. So I want to welcome Kimberly and Debbie to speak with us.
All right, hopefully I can handle this. So, good morning. I'm Debbie Norman, Program Manager with United South Broadway Corporation, and I'm here with my colleague, Kimberly Castillo, who is a paralegal with our organization, and she's also our outreach manager. So I know some of you have heard from us before, but we have a slightly different message to talk about today, which is how housing counseling can help buyers during the homeownership life cycle. And I'd like to thank the Advancing Belonging Community and Diversity Group for inviting us. Thank you so much. I hope you can hear me. Okay. And by the way, 2026 marks, can you hear me okay? Okay, I just need to make sure I stay close. Okay. It's our 40th anniversary this year, United South Broadway. We started in 1986. Oh, I'm, so, okay. I'm tech challenged, as you can see. Okay. So I'm promised. There we go. So there are tools, protections, and help at every stage for homeowners. And the full life cycle of homeownership, that means preparing buyers financially, helping them navigate market challenges and staying stable through life changes once they own a home, and helping them protect their investment long term. And we recognize the work that Homewise does in preparing buyers for home ownership, and you'll be hearing from them a little later this morning. And the job that realtors that you all play and the mortgage lending industry plays in the buying process and helping the buyer become a homeowner. And then after that, the homeowner is expected to make payments and maintain the home on their own, but life happens. People get sick, they divorce, get laid off, and maintaining stability during life changes requires additional support. And if your buyers are concerned about what might happen if their income is interrupted, they should know that help is available to keep them on track with their payments and on track to continue the homeownership life cycle to that important phase of growth, which is building equity. And I'll tell a story here. My son just made an offer on his first home, and he's a good example of a buyer who could benefit from reassurance that a financial bump in the road doesn't automatically mean he could lose his home and his investment. The closing's coming up, and he's been worried about whether he should really commit such a huge chunk of money to a house if down the road he might have to change jobs or if he gets sick or injured, especially as the home market where he lives has been leveling out recently. And it could be a few years before he has a significant equity cushion. And so he needs reassurance that he has options if something unexpected happens. And there are options. So here's what his realtor could tell him. Most mortgages include options called loss mitigation, which is a safety net designed for temporary setbacks so that the homeowner can get back on track. And buyers should know that if they do face a temporary interruption in income, such as a divorce or getting laid off or illness, there is hope. And the key to getting back on track is early communication. And here's how loss mitigation works. I'm sure many of you are somewhat familiar with it, but I'll go over some of the details. We want home buyers to know that one difficult season doesn't have to undo years of progress in making payments and building equity. And that's one of the main concerns that clients who come to see us are worried about, because most of our clients have been homeowners for many years. Some of them have lived in the same house for many generations, so or their families have. So in the event of income interruption, our housing counselors can help them apply for help with several programs available from most lenders. And by the way, some of these options will affect a person's credit, and that's something a housing counselor can discuss with them, but none of these options are going to have the negative effect that a foreclosure would have. So these are all better. One of the options is a temporary payment reduction called forbearance. And this is usually for 3 to 6 months, and it allows buyers time to get back on their feet. And then the full amount of the payments is due after the forbearance period is over. So a housing counselor can help them negotiate a repayment plan at that time to allocate the repayments over a manageable amount of time so they don't have to pay those all at once. And repayment plans add a certain amount to the mortgage payment each month to make up for those missed payments. And then a loan modification is probably the most common response to foreclosure or falling behind. And that's essentially a new loan with new terms that adjusts monthly payments, and it often adds the missed payments to the end of the loan. It's either as a balloon payment or additional monthly payments that extend the loan period. And these programs give home buyers some breathing room and time to stabilize financially. So what is housing counseling, and how does it fit into the home buyer landscape? Housing counseling was established by Congress in 1968, so it's been around a while, to help low and moderate income families maintain housing stability. However, counseling is available to any homeowner regardless of income, so there's no income cap. And our housing counseling is free to any homeowner. There's no hidden fees, and we're federally and state funded, and we serve the entire state of New Mexico. Housing counselors are required to know about all aspects of housing, including homeownership, rental rights, foreclosure prevention, and credit management. But most counselors specialize, and our counselors specialize in foreclosure prevention. But regardless of their specialty, they all have to pass a standardized exam demonstrating that they know mortgage terms, mortgage types, and the financing process, and understand financial management and also the fair housing laws in order to be certified by HUD. And HUD's Office of Housing Counseling monitors agency performance and ensures compliance with regulations. So it's a well-monitored profession, let's put it that way. All counseling is confidential, and every homeowner receives a personalized action plan, including a budget and a financial plan going forward. And I'd like to point out here, I should have made another slide, but anyway, our housing counselors also use the opportunity when they're talking to homeowners to strengthen their ability to protect their investment going forward by planning ahead and avoiding common pitfalls that can lead to foreclosure. For example, be prepared for loan servicing changes. A lot of our clients come to us and say, you know, I set up automatic payments on my loan, and now I'm getting notices that I'm behind. What's going on? Well, your lender may sell or transfer your mortgage servicing, as you know, before the first payment is even due, and it may be transferred multiple times over the life of the loan. And a lot of homeowners don't really realize that. So we tell them, make sure that you confirm that the automatic payments are set up for the correct amount and that they're being sent to the correct loan servicer. Another thing that we tell them, and something that we see, monitor your mortgage statements carefully every month, because homeowners will come to us and say, all of a sudden my house payments went up. What's going on? That's not right. Well, we tell them if your property taxes and insurance are escrowed, your monthly payment can change when those costs change. So review statements regularly so they are aware of any adjustments and can plan their budget accordingly. And then we also tell them, consider making an extra principal payment each year when they get those loan modifications or they get back on track. Even a modest additional payment toward principal can make a meaningful difference over time. And it can shorten a 30-year mortgage by maybe 4 to 6 years. It can save tens of thousands of dollars in interest, and it can help them build home equity faster. So when making the extra payment, we also tell them, put on there, apply to principal only, so that they make sure they're paying down that principal and not just the interest rate. So providing buyers information about free housing counseling as part of the homeownership life cycle reduces fears of the what ifs that homeowners have, or home buyers. It educates them about the ways to protect their credit and equity if they hit a financial bump in the road. It encourages them to seek help early if they do fall into trouble, before late fees and payments pile up. And it reassures them about long-term housing stability, that they can feel confident that they're going to be able to maintain their investment over the long term. So what happens, though, if a foreclosure notice arrives? If a homeowner misses 3 or more payments, they could face foreclosure on the home. That's the legal cutoff point for sending a notice. And even at this point, there is help, especially here in New Mexico, where they can't lose their home until they have a chance to make their case before a judge. In New Mexico, foreclosure goes through the court system, unlike a lot of states where the bank is the sole party that decides the case. Homeowners have the right to defend, their situation. Solutions are available, and receiving a notice does not necessarily mean losing their home. And another thing that here in New Mexico, in all the district courts, before a case proceeds in court, the homeowners can choose court-supervised negotiation with their lender face-to-face, usually telephonically, to solve the case. They don't have to go through it alone. Our housing counselors and our attorneys will help them through it, so they can feel confident that they have a chance to tell their story. And then USBC attorneys will represent income-qualified homeowners free of charge in the courts throughout their case. Most cases last, maybe less than a year, but some cases can last longer depending on the situation. But we'll stay with them throughout the entire case. Most homeowners don't know the full extent of their rights in a foreclosure case, but most of our clients do end up keeping their homes. Even when they need to leave, they have options such as selling the house and preserving their equity right up until the time of a foreclosure sale. A lot of homeowners don't realize that. They think if they fall behind or if they get a foreclosure notice, well, I've got to move out, the sheriff's on the way, and that's not the case. They should call us and we'll walk them through what's going to happen and what they can do about it. And they can also negotiate a cash payment for help with moving expenses. So if the worst comes to worst. So we believe access to help should not depend on income, and we stick with our clients through the whole process. We want home buyers to know that financial difficulties happen even to responsible, careful people, and it's important for them to reach out at the first sign of trouble, even before they miss a payment. If they're facing a layoff or if they're getting big medical bills or something like that, they should call. And I'll put our phone number at the end here. The sooner homeowners reach out, the more options they have to get back on track. And the sooner they'll be relieved of stress and the quicker they'll get back to enjoying their home. And like I said before, most of our clients have been homeowners for many years. Some of them live in homes that have been in the family for generations. So these aren't people who are just, buying and flipping or getting into a mortgage that they can't afford right from the get-go. These are pretty well-established homeowners, and we have about a 70% homeownership rate in the state of New Mexico, which is pretty high. So what could you say to buyers when they're considering buying or even at the closing, especially a first-time buyer? It's important to reassure them that they're not alone when they're taking this big step. Homeownership does come with support systems. HUD-certified housing counselors are available to help them if they do get into trouble. And most mortgages include those built-in options that we just described. And there's legal help available as well to people who are income qualified. And I'm going to ask my colleague, Kim, to stand up right now and just tell about 2 quick examples of cases that we just recently, where we helped homeowners. So, okay. I didn't want to make her stand up here the whole time. So, okay.
All right, guys. Well, good morning. Like Ms. Debbie said, my name is Kimberly Castillo. I'm newer to the role, but I've been working with United South Broadway on and off, maybe about 10 years. Yeah. And some of the success stories that we have seen through United South Broadway, I'm going to just call this client Mr. Smith. He came into United South Broadway looking for legal help because he had already received his summons and complaint, and he needed answers. He needed help on how to go ahead and navigate that foreclosure process. Mr. Smith had recently lost his wife, so Mr. Smith had an income reduction and was freaking out, did not know how United South Broadway can assist him. Like I said, we went ahead and we gave him some assistance. We helped him with the case. We helped him navigate a loan modification. With loan modifications, what essentially we're doing is we're renegotiating the term of his loan, and he ended up getting a little bit of a higher interest rate with the loan modification. Doing some research, we did find out that the best option would be for Mr. Smith to go ahead and take that loan modification so he can stay in his home. But we also helped him with his daughter moving in to make those payments with him. So Mr. Smith then went ahead and was able to stay in his home. We were able to keep him happy, and his daughter was able to go ahead and assist him with making those monthly payments with the income reduction. And then I have one more second story where we have a case where a young woman recently came into our offices because she had lost her job. United South Broadway, what Miss Debbie didn't say is we work with the community, and we also partner up with, what'd you say? Yeah, community health workers throughout the city. We got her in contact with Salud Morena, which is a nonprofit that we partner up with, and we helped this young woman come in, and we helped her find a job. We helped her interview, we helped her set up her resume. She came in, and within 6 months, she had gotten a new job. She got a raise within those first 6 months of her being in her new job, and we helped her stay in her home as well. So just a few little things that we do at United South Broadway. Okay. Anything else?
Thank you. Okay, so to wrap up, we just want to say homeownership is a journey. It's not just when you sign, when you sign all that stack of closing papers, that's the start of the journey. Support exists at every stage. Asking for help is a strength. A lot of people don't want to talk about their problems, but the sooner they get help, the better. And staying housed builds wealth and stability, as you all know, and as you all tell the people that you work with. Our number is 505-764-8867, statewide. And there's our website, and people can contact us either by phone or through the website. Or they can walk in at, what is our address, Kim? 1500 Walter Street. Yeah, in Albuquerque. We're in the John Marshall Health Services building. Okay, so are there any questions at this point? Questions, comments? Yes, sir.
Services are free to the community?
Yes. Yes, they are. Yes. Yes, I think Sarah said that, Sarah, yes, the slides are going to be, she's shaking her head, yes. The slides are going to be available, yes. Anything else? Okay, well, thank you so much. Really appreciate the opportunity to talk to you. Yeah.
Thank you, Debbie and Kimberly. And you all have a handout right here. And I just want to let you know that the United South Broadway and the ABCD committee collaborated on this brochure. So it could be something that you include in a broker packet. And this, it's in English and it's in Spanish. And we're going to post it to our website, the ABCD website. So this is a nice printout, but if you want more, you can go there. Any other questions before we go to our next presenter? And what we're going to do after every segment, there's only 2 more left, we're going to have a Q&A afterwards. So, okay, now I'd like to welcome Sandy Hernandez from Homewise.
Good morning, everybody. How are you guys? Yay! We're at GAR. So I have to remind myself, Sandy, you only have 15 minutes, okay? Because here at HomeWise, one of our biggest mission is homebuyer education and financial fitness. And as Miss Debbie spoke, what we do, as our first license as a housing counseling agency is helping individuals become sustainable homeowners. Now, what do we mean by sustainable homeowners? We want individuals to be housed, but maintain themselves housed, right? Like that is our objective. So we provide upfront homebuyer education, we provide financial fitness classes, and in addition, we also have a post-closing. The name of that course is Home Now What, right? Because now you own a home, what do I do? One of my clients at closing said, we closed and I said, do you have any additional questions? And he said, well, who's going to make the first payment? And it's like, wow, right? Like that's something that we don't actually discuss. So the mission here at HomeWise, one, the education and the counseling, right? And as far as our counseling, what we're going to do is sit down with an individual and do a credit, income, savings, and budget. Me, myself, as a HUD certified counselor, I am trained, educated, just 25 years in the business in order to help an individual, like Miss Debbie mentioned, provide an action plan, right? Because we don't talk to friends and family about credit, right? And now I'm going to a unknown individual and I'm saying, this is my financial resume, right? That's what we call our credit report. So this credit report, not only is it intimidating, I'm not in school anymore, but they're giving me a grade on what I do, right? So we have a credit score. So we'll teach individuals what is a credit score, how do you improve it? Even though credit scores as of November 17 for mortgage loans are no longer a requirement. However, we're looking at what is the individual's 12-month payment history in order for the individuals to get a mortgage loan. So again, big emphasis on credit, big emphasis on budget, which will trigger what type of loan can you get. So HomeWise, as our first license as a housing counseling agency, we counsel individuals for Habitat for Humanity, we counsel individuals for other mortgage lenders as well, because our homebuyer education course is a HUD-approved housing course. So when I go to class and teach, whether it be in Spanish, whether it be in English, I am a HUD counselor. I'm not a HomeWise representative in this first-time homebuyer education course. So even though HomeWise as a lender, because that is our second license as a mortgage lender, we're not a mortgage broker, so we're not the middle person. The processing, underwriting happens at HomeWise. Payment number 1, up until paid in full, HomeWise is always your servicer. So like as Ms. Debbie mentioned, sometimes you take a loan, even B of A, like they sold my loan to Faye Servicing. And then Faye Servicing sold it to Gregory, and Gregory's like, hey, Sandy, we're no longer going to escrow your taxes. And I'm like, what do you mean? That's $1,800. How am I going to start paying them separately, right? So, different mortgage companies do different things. HomeWise, as a mortgage lender, we service 100% of our loans. So your payment is never going to change lenders. As we explain to our buyers, what could happen to your payment? Even though HomeWise, as a conventional lender, we do our loans as what we call an 80-20 structure, right? So you're like, why an 80-20? Why am I going to have 2 loans? Is the term different? Is the rate different in each of these loans? Well, the rate is the same. They're both the same rate. They're both a 30-year loan. Why does HomeWise does this? As you guys know, Fannie Mae, Freddie Mac, who oversee mortgage lending, say, hey, if you don't do 20% down, you're going to have private mortgage insurance or mortgage insurance premium if it's an FHA. And Homewise says that insurance could be anywhere from $50. We had someone last week, $220 a month. Because of their credit score, because of loan to value, they have a high mortgage insurance premium. This premium is paid to the lender, right? It's not, it's paid to the insurance. It's not something that is convenient to the client. It's just making their payment higher because they are considered to be a high risk, right? So it's a protection to the bank. So basically, this mortgage insurance premium says, hey, Wells Fargo, give them the loan. If they default, I'll pay, right? But one way or another, the bank is guaranteeing their money back, right? So Homewise says, we're willing to take the risk, do an 80-20 loan, but in addition, we can finance closing costs into this small second. Yes, what does that mean? Yes, it may mean that your client may owe up to 102%, but you know what? Owing a little bit more the first 2 years, but instead of the client coming to closing 3 to 5% down plus closing costs, right? That easily can be 5 to 10% at closing table. Homewise says, we'll do as low as 1% down payment plus $1,500 for your upfront closing costs, such as appraisal, earnest money, and home inspection, right? So your clients are coming in with less money. Now, in addition to this conventional loan, not only do we do individuals with a Social Security number, we do individuals with an ITIN number. It's an identifier tax ID number for individuals who have no legal status. So most individuals is like, Homewise, are you guys crazy? Why are you willing to take that risk? Everybody has to pay housing, right? So we offer a loan. That loan for the I-10 financing is 5% down. We can also roll in the closing costs into the loan. What types of properties does Homewise finance? We do single-family homes. We do manufactured homes. The only thing manufactured, because of CLTV reasons, it does have to be 5% down plus upfront closing costs on the manufactured homes, okay? So why not take advantage of this loan, right? Like it's an 80-20. Again, in home buyer education class, we will talk about other lenders. Who other lenders offer FHA, VA? Homewise currently is only offering conventional loans. So one other thing, as Homewise is a housing counseling agency, it also opens the doors to receiving down payment assistance. Whose eyes went, what? Down payment assistance? Yeah. So one, we are an MFA approved lender. So as we talk about rates, we do try to do the lowest rate. There's two different ways that we look at rate per the MFA website. You know, if they're under, like $89,000 for a family of two, we can use the lowest rate. If the client goes over income, and we have to go to the traditional rate sheet based on their credit score. So that's a different way that we'll look at what is the best option for the client. Now, as a housing counseling agency, the city of Albuquerque is like, hey, Homewise, you guys do an amazing job educating individuals. Can you administer this down payment assistance? So this down payment assistance, we've had it for 5 consecutive years. We currently have 2 slots. So if you have someone that's looking, hurry up and get your purchase agreement in. There's 2 slots, which are $40,000. And the individual lives in the house for 15 years. After 15 years, wow, forgiven. Everybody go, wow, forgiven. Wow, $40,000 at 0 interest, 0 payment, right? Obviously, the city of Albuquerque has some restrictions. In the event that you rent, refinance, sell, or pass away, the money becomes due. But all these years, that assistance is at 0 payment, right? So it gives the individual, hey, you have a little bit of extra money, put it towards that performing second, get rid of it, right? And hopefully we've reapplied. We should have more funds after July 1st. There is also a second assistance. As a HUD Housing Certified Counseling Agency, HUD is like, hey, Homewise, administer this census tract money for us. So this census tract is depending on the address of the home. So we go to the HUD website, census tract, we input the address of your purchase agreement, and we'll say, oh, it's considered to be in a low to middle income tax bracket. Here is $20,000 of down payment assistance, right? So $20,000, who has $20,000 at 0% interest? I don't see anybody saying me, right? Because it's, again, something that Homewise is administering for HUD. Third, we are currently administering an additional down payment assistance for City of Rio Rancho employees. So if the individual has been employed by the City of Rio Rancho for 1 year, they can go to the City of Rio Rancho HR and say, I want to be a down payment assistance candidate. The individual's name gets referred to me, and then we say, okay, you have to meet requirement, be employed for 1 year. Very, very different than the City of Albuquerque and the census tract money. This City of Rio Rancho can even be for non-owner occupants, right? So the other ones are owner occupied. This one is even non-owner occupants. And they're doing $20,000 assistance, and they do a gradual forgiveness. So it's 20% forgiven each year. So at the end of 5 years, again, the $20,000 is forgiven. And so there is also a couple of slots available. And in July, also the City of Rio Rancho is going to revisit. Hopefully this will be the third time that we get additional funding for the City of Rio Rancho. So if you're curious, how does my client apply, right? Unfortunately, these three assistances, Homewise does have to be the mortgage, for City of Albuquerque and census tracts, Homewise does have to be the mortgage lender, but for the City of Rio Rancho, it could be any mortgage company. So even if you're working with PRMI or any other banks, again, the City of Rio Rancho does allow other lenders, and we just administer the money for them. So great ways to help the community, right? Because all this money is zero payment, zero interest. Now, if you have an individual and you're like, Sandy, my client doesn't have the down payment. Sandy, my client is struggling on credit. Again, as of November 17, we don't have a minimum credit score requirement, but it's looking at that 12-month payment history. So we have a lot of young adults that haven't started credit, or like me, left to the Army, they give me a credit card. I was out in South Carolina, my credit card bill came here, and I was late. I started my credit with lates, right? Because I didn't know and I didn't get the bill. 25 years ago, we didn't have online banking, right? So I started with bad credit. And I'm not embarrassed to say it. Thankfully, I've improved. Pat on the back, Sandy. So this amazing credit building program, and this is money from Chase Bank. So as you see, we have a lot of partners that work with us. So Chase Bank said, hey, Homewise, administer this money. And what we want you guys to do is pledge $1,000, okay? We're going to tell this individual that is having credit issues or budgeting issues, and we want the individual to save $1,000 as well. So what Homewise is going to say, March 15th, April 15th, May 15th, June 15th, every month draw $83.33 from the client, but the client is doing a savings. So key word to the program, credit building savings program. So it's doing credit and it's also doing savings. So again, we pledged $1,000, we put it in escrow. This is not money in the pocket, but it's reported as a loan to the credit bureau. The savings from the individual is, again, savings. Once the individual saves $1,000, okay, then Homewise says, you build your credit, you build your savings, no questions asked, you can walk away. It's okay. It's a grant. Here you go, $1,000. Yay, pat on the back, you fixed your credit. Now, the biggest advantage of this program is if the individual now qualifies for a mortgage. So all the I's are dotted, all the T's are crossed, we have a DU credit approval, and the individual qualifies to buy a house. Then Homewise is going to say, you know what, you did an amazing job. Instead of us only pledging $1,000, we're going to pledge $9,000, give you your $1,000, and now the client has a credit at closing for $10,000. Wow. All they have to save is $1,000, and now they have $9,000 towards their down payment. So my lenders out here, if you have an individual, $3,000 down versus someone doing $10,000 down, what's easier to get approved? I see a couple of smiles. What would be easier? 10 grand, obviously, right? So this is an amazing program to help your individuals build credit, save for down payment, right? And it's a tool. And again, this is money from Chase Bank that Homewise is administrating. Questions? No? Yes, sir. No, the max, the max for the program is 1,000. And so there is a minimum 6-month enrollment in the program because Chase is like, we can't match you if you save within 2 months, right? Like the purpose is helping the individual build credit. And as you guys know, something under 2 months isn't going to build your score up. And in average, this credit building program is averaging 83-point increase to the individuals. So it's an amazing tool. Yes, James. We do. Yeah. Yes. So if we have an individual and they say we want credit counseling only, we can do the credit dispute letters for free because, again, there's currently a team of 4 of us that are home purchase advisors, and we'll do the dispute letters. Obviously, we'll try to teach the individual. If you can do it on your own, enroll to the bureaus, and you can get them off within 7 days. If I have to do it, I can only do it by mail, and it can take 60 to 90 days to get those off. Mm-hmm. Yes.
Hold on, we've got microphones, so.
Oh,
Oh, on that last program you were talking about for the savings, do they have
Yes.
to do the mortgage with Chase?
Homewise.
Homewise.
Yeah, Homewise. Mhm.
Sandy, that was so awesome, and
Thank you.
I was like this the whole time. I will tell you one of the main questions that I get about Homewise is usually from my realtor partners. And so if a buyer has a realtor already and they refer to Homewise, are they able to retain their existing realtor?
Definitely.
That's
and
for sure a
so
question.
on our profile, it'll say who were you referred by, and we'll have them put your name. And once the individual discloses we have a realtor in our system, we'll automatically put that. Because Homewise has 3 licenses. The first license as a housing counseling agency, second license as a mortgage lender, and then 3, we also have realtors in our office.
Once they go through the program and they give you the $80 and they get their money and maybe get the $9,000, how long is that money valid for them, or how long can you hold it for them if
Yeah.
they're going through the process of looking
Yeah,
for the
we
house
have
and
to
can't find
use
anything?
the funds by November of 2027. Yeah, and so if you do $83.33 a month until 12 months, it would be 1,000. So the program is designed to be a year, but we can graduate as early as 6 months. So what would that mean? In 6 months, I've only paid $500, right? So if you want to graduate at month 6, out of pocket, you need to put the other $500 to do the 1,000 match. Yes, Miss Laura.
Hola.
Hola, hola.
So I know you mentioned you're using the MFA census tract, right?
No, the census tract money is HUD. MFA for the rate.
But the census tract,
Yeah.
to track the addresses. Would
Yes.
it be for the
HUD.
previous year? Because I know like MFA was using 2023 census tract. Are you guys on like 2025 right now?
The census tract is a HUD website. It's not an MFA. It's directly through HUD.
Okay, but
Yeah.
you're using 2025?
I don't know that they published the year on this, because there's 3 different fundings, 2021, 23, and 24. And so like 21 right now is only for rural areas. So if there's rural, sometimes there's even a little bit more money. But there's different funding brackets that we tag onto, but the map itself, I don't know that it has a date.
Yeah.
It's a live.
Because I don't know if you remember anybody used when they had the grant for MFA. There was a time where they had a grant, like a $20,000 grant, depending on the census tract. But this was back like in let's say for example 2023, and they were using 2021 census tract. So there is a drop down to where you could choose what year.
Yeah,
it
we
does
have
change.
3. Yeah, we have 3 funding opportunities, and each year the map is different. Yeah.
Cool. Thank you.
Of course. Thank you guys so much. And we'll be around at the end.
Yeah, thank you, Sandy. That was great. Thank you very much. As you can see, there are lots of supports to help our buyers. And depending on their circumstances, they have many options, whether it's getting the support they need to become financially responsible, needing some assistance in getting a loan, and then also us as lenders, we can also provide the assistance. So today's presentation, it's a collaboration of 3 lenders in the ABCD committee, myself, Faith Begay-Holtrop, Allyson, Mendoza, and James Rhodes. Why isn't James up here? Because we had to split the presentation in 3. So Allyson and I are going to present, and then we're putting James on the spot for all the Q&A. So get ready for all your tough questions. He'll be ready to answer them all. So we'd like to talk about what buyer power looks like from the financing side. As realtors, you know the housing market, you know pricing strategy, and you know how to negotiate. You know how to get the buyers under contract, and we're going to talk about how the structure is behind the scene, because that's where a lot of deals either are strengthened or they quietly fall apart. So as quality local lenders, our goal is not just to pre-approve. Our job is to make sure everyone gets to the closing table. Getting a house under contract is exciting, but getting a clear to close is up for celebration. So, okay, here we have. We'll start with what happens before your buyer even writes an offer. We're trying to help them prepare financially for a mortgage. Pre-approval is just not a credit pull, and you're good to go. If it were that easy, Zillow would be running underwriting departments, and you know how we feel about Zillow. We meet and talk with buyers to assess their financial circumstances, and we want to make sure that we understand the process of applying for a loan, answer any basic financial questions, and help them make sure they are making the best financial decision for their personal situation. So you guys probably know some of the 4 things that we look at for credit, and I liked the financial resume. Yes, the credit score matters, but structure matters more. Sometimes it's not just about the credit score, it's about paying down the right loans and credit cards. It's about fixing utilization, fixing credit, and even establishing credit. And so we want to avoid mid-transaction surprises. We talked to them as well, so I'm sure you've heard this. I've financed furniture in the middle of the loan process. So we like to talk to our borrowers about trying not to take on additional debt during their loan process. Also trying to not to increase their credit usage before the loan funds. And the key word here is loan funds. That's after signing. So please remind your borrowers that they can go on their shopping spree after they get the key to their house, not after they sign. So borrowers will still sometimes check credit after they sign. And interestingly enough, I had a borrower recently who went rogue, and she wanted to pay down her credit card, so a friend gave her some cash, and she paid down her credit card with cash, and that raised a red flag. So we had to start the process over months later. Income. This is where mistakes can happen, especially with variable income. Bonus, overtime, commission, all of this income needs to be averaged. And you, as realtors, as mortgage loan officers, you know this, you're self-employed. This is where we have to average income, and self-employment is a different animal in regards to analyzing income. Online calculators don't factor that correctly, so please rely on your mortgage loan officers, the resources of people we're talking today, because we're the ones who can help calculate the income, especially with something like MFA. You know, they could afford a certain loan, let's say under FHA or conventional, but they may not qualify with their income under MFA. So it's important that we take a look at it to make sure. And the same example, just because someone makes $120,000 doesn't mean they can use the full $120,000. Assets. And assets aren't just a down payment. Assets are the down payment, closing costs, reserves, and then gifts too. And we have to make sure that all of this is documented properly. During our conversations about assets, this is an opportunity where we uncover a possible need for DPA, and I'll talk about that in the next slide. Also, we look at work history. We look at a 2-year work history. We look at gaps, education, job changes, and especially in today's market, there are many people who have changed jobs within at least a year. So upfront, an upfront offer is stronger. Your buyer isn't just pre-approved, they're positioned to close, and more importantly, after we talk with them about this information, it's more, your mortgage is more predictable. Now let's talk about DPA. So we have, when you think DPA, a lot of people think, what do you always think, DPA? First-time home buyer, right? They're the only ones eligible for DPA, but that's not necessarily the case. We have traditional first-time home buyer programs such as First Home and Home Forward, but they can have stricter credit requirements, income limitations. They have to take some education classes, and they are great. They play a role in how we can qualify candidates. But between the lenders in the room, we also have several options that don't require first-time home buyer status or have income limitations. So you can have a lower credit threshold, and some are even forgivable. So what does this mean for DPA? It means that a lot of buyers have the income, and they can't afford the payment. They just don't have, I think someone said, they just don't have the $20,000 they can pull out of thin air. So they're great candidates, but we can help them with getting this additional money. So this expands who can qualify for loans, and without stretching anyone too thin, because we want to work with everyone to make sure they're going to be financially able, it fits their budget, to get the correct mortgage that works for them. So we're going to have Allyson continue.
Hello. So piggybacking off of down payment assistance programs with additional and alternative assistance, but coming from the seller. So we have the same $10,000, but 2 very different results. And we're just going to use a kind of a basic purchase price of $365 with 5% down, 6.75% interest rate, just a standard conventional loan. Just a P&I payment of $22.49. So with a price reduction, your new purchase price is $355, new payment is $21.87. So you can see a very small monthly payment improvement, a small loan amount improvement, but not much for the price reduction. Not a big impact. So where we see the biggest impact is the seller credit. You can use the seller credit, same $10,000, to buy down your interest rate. Let's say 6.75% to 6.125%. It's sort of a balancing act. So you can use half of that to buy down your interest rate, and the other half to cover the rest of your closing costs, or $7,000 and $3,000. Just kind of depends on where you're at with your own closing costs. So it's a larger impact, stronger impact payment, or for your payment. So every $1,000 in price reduction only lowers, oh, sorry, am I too loud? Every $1,000 in price reduction only lowers the payment about $6 or $7 a month with today's rates. You said this one? Okay. And then just one more example for what can help as far as seller credits. So additional ways to help buyers with long-term affordability would be a 2-1 buy down. I know a lot of lenders offer different buy downs, 1-1 buy down, 2-1 buy down, 3-2-1 buy down. But just for an example's sake, we'll just go with a conventional 2-1 buy down, same purchase price, 5% down. So for a 2-1 buy down, it's a temporary interest rate reduction funded by the seller to make the buyer's first 2 years of payments lower. So year 1 is 2% lower than the note rate. Year 2 is 1% lower than the note rate. And then year 3 and on, the loan returns to the fully fixed rate, not the reduced rate. So the lowering your initial monthly payment, it helps ease the transition into homeownership, providing time for raises or promotions or bonuses, future financing. So sometimes people are waiting on that promotion, or their family had a baby, and someone's out of work. This can really help ease them into the homeownership, and the payment shock isn't so scary. So really great for first-time home buyers, buyers stretching into a higher price point, and expecting more income growth. And then, let's see. So why loop in a lender early? I know a lot of you already do this. But numbers win negotiations. We can help you structure loans by asking the sellers for help. And we've already defined the real budget. So your true DTI calculations, we've prepared buyers with property taxes, homeowners insurance, so they know what their real payment's going to be. We show how interest rate shifts affect purchasing power. And as Faith said, it protects the deal. So there's less surprises moving forward through underwriting, and you get to the closing table. So us lenders are working when your guys' buyers are looking, so you can always reach out to any of us lenders, and we'll be ready for you. And I think that's it. Do you want to add anything else? Yes, you can.
Just a little clarification. Yeah. There are hundreds of ways we can structure loans, right? I mean, so we could sit up here all day, take questions, and we don't mind taking questions right now if you have an individual situation. But I just wanted to add something with the 2-1 buy down. And I don't want to get into too many semantics, so if you have any questions about it, you can ask any three of us. So, or you can ask James right now. But going back to the 2-1 buy down. So you'll see that in this scenario, it costs $8,000. It's a subsidy to pay for the interest. So then they can have an additional $2,000 for closing costs, not the $5,000 before. But you can see the new payments are significantly different than the other two. So the price reduction only saves someone $62 a month. If they do a permanent rate buy down, it saves them almost double, $142. But if they consider a 2-1 buy down, they can save, $440 a month in monthly payments their first month. And the nice thing about this is during these 2 years, they could possibly refinance. And the subsidy payments that are paid by sellers, they're prorated, so they could possibly be refunded back to the borrower if they decide to sell or refinance or anything. Okay, so that's what I just wanted to say about that. Allyson did a great job. There's a lot of information there. And I see someone has a question back here, and we're going to let James take over with the Q&A.
Happy Wednesday, everybody. Hump day. I'm James Rhodes with PRMI, part of the ABCD group, and I'm the one that gets to be put under fire. So go ahead and shoot away. Anybody have any questions? Mortgage financing, anything?
What's the cost of that 2-1 buy down?
So the 2-1 buy down, the way it works is it's really just a calculation. So a 1-1 buy down, 2-1 buy down, and a 3-1 buy down. On the thing up here, we're looking at about $8,000. So in order to it, we just kind of run it through an Excel spreadsheet. It tells us exactly what that subsidy is going to cost, and then that's what the seller would have to pay at closing towards that subsidy. So typically like a 2-1 buy down is going to run you about $8,000. 3-1 buy down is going to run you between like $15,000 to $17,000. Okay. But as kind of Faye showed you guys, if you guys have sellers that have houses on the market and they're trying to do a price reduction, that money goes so much further if you just give it to the borrower to help them buy their rates down. Yes, ma'am. Oh, yes, ma'am.
So what's the max seller concessions percentage-wise that a client can or buyer can receive for conventional FHA and VA?
So it depends upon down payment. So conventional, if you put 5% down, you're limited to 3%. If you put up to 10 to 15, 20% down, then you're looking up to 6%, 9% in some aspects. If it's an investment property, you're looking at 2% on those concessions. Okay. Yes, ma'am.
Hold on, Dava. Dava, you need the microphone. Hold on.
So my question actually piggybacks off of Carmen's. So if I'm understanding, depending on the max allotment on the loan type, we would have to factor that in. So you'd be able to utilize the buy down towards the amount of credit they can get. So there is going to be a ceiling. So if they are also trying to negotiate credits, that's going to be something
that's going to be part of that IPC calculation. Yeah. And so if it goes over a lot of the allowed IPCs or interested party contributions, then it's not going to pass compliance. So on a $300,000 house, they're putting 5% down. They're limited to $9,000 as a seller concession.
Right. So like that 3-1 buy down would not work, but possibly the 2-1 buy down and then maybe $1,000 credit is
Absolutely.
kind of what I'm saying. Okay.
Absolutely.
Okay. Thank you.
I'm just wondering about the numbers, the 2-1, the 3-1, the 3-2-1. I always wonder, does that mean the year? Like, and why don't we call it a 1-2-3? Like, why do we do 3-2-1?
I don't know. I don't know. I don't know why they call it that, but I mean, if you look at it though, right, you do a 2-1 buy down, you're using 8, so they give us, let's just say they gave us that $10,000, right? So we still have $2,000 left over to use towards our closing costs. But at $8,000, they're saving $440 a month for a year. You know what I mean? Like, how much money is that per year? The second year, they're saving $225 for a year. And then it finally goes to the fully indexed rate. So it works for a lot of people. Maybe they know they're going to be getting a raise in a year. Maybe they know that they're going to get their cars paid off or something like that. But those first 2 years are going to really help them afford that property. Even though they can afford it at the fully indexed rate, it's helping them save a hell of a lot of money over the course of those first 24 months.
So the 2 means 2% or
No, so it's a 2-1 buy down means your first year is always going to be 2% less than your fully indexed rate. 3-2-1 buy down means your first year's 3% lower.
So it's percentage.
Yeah,
Okay.
exactly. So if you guys have like builders, right? There's so many builders out there right now giving incentives, flex cash. We're doing things with like Hakes where they're giving like $60,000 on some of these properties. What we're doing with that is we're blocking those rates. We're buying people's interest rates down to like 4.25. I have a guy closing in about 2 weeks. We bought his rate down to 4.25, and we had enough money left over to do a 3-2-1 buy down. His first year, he's paying 1.25% on his mortgage for 12 months. Second year, 2.25. Third year, 3.25, and then finally by the fourth year, he'll be at 4.25%. So there's a lot of ways you can maneuver these. Like, that's hard to do with private sellers, right? We can do rate blocks with private sellers, but that's kind of crazy. But with builders, if you guys are looking at places like that that are giving like flex cash and stuff like that, there's so many things you can do with that money.
And then afterwards, they're going back up to the 6.75?
No, because so really we're buying, like on this instance, yes, right? Because they're not permanently buying down that fully indexed rate. They're qualifying at what they can qualify today. When you're using builder flex cash, we basically take the IPCs out of it. We're taking a chunk of that $60,000 and taking it on the back side of it and taking it outside the IPC. So it's not hitting our contributions. We're buying that rate down permanently to like 4.5, 4.25, right? And then we're using the rest of the money to use a 3-2-1 buy down on there. So with builders that you have lenders that allow kind of block rates, you have a lot more maneuverability than you do with kind of private sellers in that aspect. With that amount of money, there's not a lot of sellers out there giving $60,000, right? But
And they're, like James was saying, sorry, I mean,
No.
but, we just chose one example, $10,000, trying to think of maybe more first-time home buyers, but this is great for the builders. And also, I want to point out that your buyers do have to qualify to pay the higher payment. So they do have to qualify to make that $2,249 payment, even though they won't be doing that in the first 2 years. And the 2-1 buy down, so you can see there's two numbers, so you know it's 2 years, okay? The first number is 2%, and then the 1%. 3-2-1, there's three numbers, 3%, 2%, 1%. So that's sort of how you remember what they are. And then there's even a 1-1.
Yeah, and there is a 1-1, yeah. So,
4, 3, 2, 1, blessed off.
yeah. But like in this instance, what they're talking about, like that $10,000, I mean, before you have your seller drop their price 10 grand, which might open up to a handful of more borrowers, right? New buyers. If you kind of show that on the MLS that, hey, we're giving $10,000 towards your closing costs, towards a 2-1 buy down, whatever like that, you're going to attract a little bit more buyers because now they can afford that payment more than just dropping that payment or dropping the price by 10 grand. You get more bang for the buck giving it to the buyer. Anybody else? Well, the savings on that, I mean, if you can see, I mean, I can't do math without a calculator. I'm not a savant, right? It's about that. But at 440 times 12, I mean, that's $5,000, right? You're saving in the first year. Right? Yes, sir.
It was 5,280 if you do that.
Yeah, okay. Well, yeah, it's right there. Duh.
Yeah.
Yes.
So you're just really buying that. Now, if I had that $440 a month, can I apply that $440 towards my principal?
Absolutely.
Thereby
Every day of the week.
Because I'm slamming $8,000 off my note at no interest.
You know, if that would probably be the absolute smartest thing for the buyer to do, right? If they qualify at that $2,249 payment and they're comfortable with that payment and then they do the buy downs, whatever they're saving per month, I would absolutely tell them to throw that towards principal. 100%.
So there's no rule against doing
No,
that.
no.
And
Yeah.
why does this make more sense than, other than you get the lower payment for a while, why does it not just make more sense to take the whole 10K, buy more points, and get a lower interest rate?
So over the term of the
that one at
loan,
the
right?
top?
Yes.
Why do I not just throw all 10K right there?
So over the term of the loan, and I think we all kind of know that kind of mortgages kind of last about 7 years before somebody either upgrades, they refinance, they do something, right? So as mortgage professionals, we're going to look at the return on investment. Is that $10,000 better served to you buying your rate down to maybe 6.125? And are you going to recoup that investment over the next 10 or 7 years before you refinance, before you sell? Or are you going to save more money doing the 2-1 buy down, the 3-2-1 buy down over that course of 7 years? Really, that math always works around 7 years before somebody buys a bigger house or refinances their property. So there's a lot of numbers that we're going to throw at buyers and give them kind of apples to apples. Which one's going to best fit your needs, right? What's going to be the best for your family? It might be a short-term saving is going to be much better for you than a long-term saving, right? Because if you're in that house and you buy it down like, say, 6 1/8, and then you refinance in 4 years, you never kind of recoup that money, right?
Saw it.
Yeah.
Right. And one other question, what is the main reason you're seeing loans fall out of contract right now? And what percentage of them if you had 100 loans go through in the last 4 months, what percentage
Inspections,
didn't
I'm
make
seeing
it?
some kind of fall through. Like typically with mortgage people, we're pre-qualing people to the nth degree, right? Loans have gotten harder over the last 10 years to get people qualified. There's been so many guideline changes as it pertains to the way that we calculate income. Variable income is like the demon in the room over the last 3 years. It's always been on the books, but it was always kind of calculated differently up until about 3-4 years ago, and all of a sudden it's just calculated so much differently now. So that's one of the biggest things, right? We get buyers that come in and go, I work 40 hours a week and I make $20 an hour, blah, blah, blah. This is what I did. They put in the application. Well, then you get your paycheck stubs and they're hourly employees, and last week they worked 37 hours. And the week before that, they worked 35 hours. And then 3 weeks prior, they worked 40, 40, 40. But if they're not tracking to meet that 40 hours a week on their year to date, man, it's called variable income because they get paid a little bit different on every single paycheck. So what they think they make today isn't really what we're going to be able to qualify them at, because we're going to take 24 months and year to date and average that income. because their income varies, right? So those are probably the ones that I see that think they can, but once we calculate, they really can't because maybe they haven't tracked that 40 hours for the last 2.5 years. Salaried people are just easy, right? You just take their salary divided by 12, so that's kind of easy. But fallouts really are kind of income assets, but as we've shown, there's a lot of DPA products out there that help people get into it. Now, what you'll hear, though, on the DPA stuff is your interest rates are going to be higher except for MFA, right? MFA, phenomenal. Homewise, I mean, guys, come on. Homewise is a fantastic product. I don't work for Homewise. I'm a competitor, but I'll tell you honestly, I refer people to them all the time because they do a fantastic job for people. But with DPA stuff, typically outside of MFA, you're going to look at higher interest rates, right? And I sent one to a client a couple of weeks ago, and her response, and I explained to her the whole process, what the rates are going to look like, how everything's going to look. And the response I got was, well, my credit score is a 720 and I have great income and I'm looking online and interest rates are at 5.99. Why is mine at 6.875? So I had to kind of go through that whole thing again. You know, with DPAs, you're paying for the DPA, right? So that interest rate's going to be a little bit higher. They do that because you really have no skin in the game. So it's a higher risk loan. They're going to have a higher interest rate because they need to maintain those funds for more borrowers. They need to make sure that those funds are always going to be available. So it's kind of an insurance policy on that side. If you're doing DPA, you're most likely going to have a higher interest rate on those, right? And now the other thing, before questions, the other thing, like as mortgage people, we always look at the full financial picture, right? If somebody has a 401k, they're looking at a DPA, but they have a 401k that they can take a loan out of, then we're always going to have those conversations with them, right? Where's the cheapest money? Where can you borrow the cheapest money? And quite honestly, you can borrow it from yourself a lot of times. So if you have a 401k that you can take a loan out, a lot of times that works out better than doing DPA because you're taking that money out of your 401k and then you're paying yourself back with interest. You're not paying a lender at 8% or 8.75 on a second mortgage. You're paying yourself back for that money. And we're always going to look at every aspect, what products they fit into, and we're always going to give them options. Compare apples to apples, right? Anything else?
I have a quick, did we answer your question? Were you asking why people were defaulting or why people?
So more the question was, once you're in contract, so you've done your job, we've done our job, we're in contract, we have a closing date, and we don't hit that. Why are you seeing deals, in-contract deals fall out? Is it inspection?
A lot of it is inspection, right? Yeah. A lot of that with inspection. I haven't seen a lot of fallout lately, but a lot of it has been inspection. Some of it's been appraisal, right? Appraisal's coming back a little lower than expected, and there's not really any negotiating power there. Borrowers are not willing to come in with that additional money. The sellers aren't willing to come down on their appraised value. So there's a menagerie of things like that, but typically kind of inspections, appraisal is really it. Yeah. Yes, sir.
And Allyson and I were talking before the presentation. We've had a couple people quit their jobs. So,
Yes.
I mean, it's a big one. So then that income goes away.
3 times in my buyer broker presentation.
Exactly.
3 times I told you.
Yeah. Anything else, folks? Yes, ma'am.
All of that was so awesome. Thank you guys for being here today. As a different note, I was at a different event yesterday, and one of the questions that came up, it was with an underwriter, was, as lenders, what is something that you guys do not want to see on the resolution? And there's been mixed feedback as to the exact language. Like in the past, we could do credit in lieu of, and now so many lenders are saying, don't do that at all, just say credit, right? So can you give some examples of maybe what will definitely
Carpet
set things
allowance, that's my favorite. Carpet allowance, we're gonna give a carpet allowance, that's kind of gone out the window, right? We don't really do this. If you guys are gonna give credits in lieu of repairs or something like that, just put, we're gonna give you a credit, period. The least amount of information with the same information is better for us, because the more information you give of why you're giving that credit, it just opens that door a little bit more for the underwriter to question what we're doing. Well, now, because I just had one like that where in lieu of doing some repairs, they were going to give a credit, but they put that on the resolution. So now my closer wanted to see all the invoices that repairs are done prior to closing, and then that kind of, so last minute, everybody's kind of trying to get these invoices. So the least amount of information you can give us with the information we need, does that make sense? The better for us, yeah. So instead of doing, hey, we're gonna give $5,000 instead of fixing the hot water heater, just put, we're gonna give you $5,000, right? Yeah. Anything else, folks? Cool, all right. Thank you. Absolutely, thank you guys.
Thank you all for coming. Our next First Wednesday is April 1, protecting your assets. So we hope to see you there. Thank you.